It began as a quiet morning in the global currency market until the numbers suddenly changed. Traders watching Iraq's official financial platforms noticed something so shocking that screens across the world lit up in disbelief. The Iraqi Dinar, long considered one of the most undervalued currencies on earth, appeared to have shifted dramatically against the US dollar. Within minutes, whispers spread from Baghdad's central bank terminals to online Forex chat rooms. Had Iraq finally pulled the trigger on a long-awaited revaluation, or was it nothing more than a fleeting technical glitch? For years, dinar holders have lived between these two worlds, hope and confusion, waiting for a moment that might turn a simple investment into a life-changing reality. What happened in early 2025 shook even the most skeptical observers. The Central Bank of Iraq's online rate feed briefly displayed figures that didn't align with previous trends or with the official pegged range against the US dollar. The numbers were precise, dated, and then just as suddenly reverted to normal. Analysts described it as a possible data synchronization error. Yet, insiders in Baghdad claimed that testing of new rate systems might have been underway. To understand the magnitude of that event, it's important to remember that Iraq has been walking a fine line between monetary reform and economic recovery. Since 2003, its economy has relied heavily on oil exports, and the dinar's value has been artificially managed to ensure stability amid regional uncertainty. However, the country's financial sector has undergone significant restructuring, driven by both internal reforms and external pressure from international banking institutions. The Central Bank of Iraq, CBI, has been actively modernizing its systems, integrating advanced digital payment infrastructure, and aligning its policies with International Monetary Fund (IMF) and World Bank recommendations. This modernization, while technical on the surface, holds deep implications for the Iraqi dinar's valuation. When that sudden shift appeared online, showing what looked like a new exchange rate, it instantly reignited old debates about whether Iraq was quietly preparing for a valuation, renomination, or a full currency reform rollout. What made the event even more suspicious was how swiftly the central bank's online portal went offline for scheduled maintenance, followed by a carefully worded statement hours later, denying any rate change and attributing the anomaly to a technical update. Yet the timing of that glitch coincided with reports of meetings between CBI officials and major private banks, where confidential discussions about rate adjustments were allegedly taking place. This overlap was enough to send shockwaves through both the dinar investment community and regional media outlets. Economists began dissecting the potential causes. Could it have been part of an internal system test, perhaps connected to Iraq's new electronic settlement platform designed to streamline cross-border transactions? Or was it a genuine early reflection of a yet unannounced monetary shift? Observers point out that Iraq's economic data over the past 2 years paints a cautiously optimistic picture. The country's foreign currency reserves have surpassed $120 billion, one of the highest in the region's history. Inflation has remained relatively low, oil production has stabilized, and the government has made visible strides in combating currency smuggling and corruption, both critical barriers that once prevented any serious talk of revaluation. Moreover, 2025 has seen Baghdad deepen trade relations with China, Turkey, and the European Union, with contracts increasingly denominated in both US dollars and local currency. All these indicators contribute to speculation that Iraq is indeed preparing for a gradual appreciation of the dinar, aligning it more closely with its true economic potential. However, the question that remains unanswered is whether the incident was accidental exposure or intentional signaling. Central banks around the world occasionally conduct silent dry runs, testing exchange rate adjustments on internal systems before any public rollout. Such tests rarely become visible to outsiders, and when they do, it often hints that something more substantial is underway. Some insiders suggest that the Iraqi Central Bank may be under international observation, particularly from the U.S. Treasury Department and Basel Committee, to ensure that any move toward revaluation aligns with anti-money laundering protocols and global financial stability measures. If this was indeed a system test, it would imply that Iraq has reached an advanced stage of readiness, something not seen since the post-2017 stabilization phase. At the same time, veteran analysts warn against overinterpretation. Similar rate flashes have occurred in previous years, especially during system updates or when new electronic platforms were integrated with swift banking networks. Still, what makes this particular case unique is the credibility of the data sources. The rate appeared not only on one CBI-linked feed, but also on 2 affiliated financial data providers, both of which briefly reflected the same value before it disappeared. This level of synchronization reduces the likelihood of a random glitch. If it were truly a technical error, it would suggest a systemic issue, not a single entry mistake. As news of the rate change spread across Telegram channels and investor forums, screenshots began circulating worldwide, with speculation intensifying by the hour. Some users claimed that the dinar had been shown trading at nearly 1.47 USD per IQD, a figure that, if verified, would mark one of the largest overnight value jumps in modern currency history. Others argued that such a rate was implausible, pointing out that Iraq's monetary supply and oil dependency would make such a valuation economically unsustainable. Still, the mere appearance of that number was enough to send ripples through currency speculation markets, where trading volumes for dinar-related derivatives briefly surged by over 30% in under 24 hours. Whether it was truth or illusion, one fact became undeniable. The Iraqi dinar had once again captured global attention. In the aftermath, financial journalists began revisiting the fundamentals. Conditions would need to exist for a genuine revaluation to occur. Iraq would require full fiscal stability, international backing, and a robust monetary framework capable of withstanding speculative attacks. Interestingly, many of those boxes have slowly been ticked off in recent months. The central bank's ongoing efforts to curb parallel market rates, stabilize the black market dinar, and strengthen its banking ties with regional partners have given Baghdad unprecedented leverage. When viewed through that lens, the so-called glitch might not be an isolated blip at all, perhaps a small glimpse into a much larger economic transition quietly taking shape behind the scenes, one that could soon redefine the Middle East monetary landscape. In the days following the incident, the atmosphere surrounding Iraq's financial system grew increasingly tense and speculative. Investors, economists, and ordinary citizens all found themselves asking the same question: was this moment a mere flicker of error or the first public trace of a major economic shift? Inside Baghdad, government officials appeared unusually cautious. No minister or central bank director was willing to comment beyond the official statement, which emphasized technical irregularities. Yet, sources close to Iraq's finance ministry indicated that behind closed doors, there had been a series of emergency consultations between fiscal policymakers, private banking representatives, and international observers from the World Bank and IMF. These meetings, while unconfirmed publicly, were said to focus on the delicate balance between exchange rate control, debt obligations, and upcoming monetary restructuring programs due later in 2025. The tone of these discussions, as reported by economic correspondents, reflected the seriousness of a government standing on the edge of a financial breakthrough or potential crisis, depending on how the narrative unfolded. As media coverage expanded, the global response grew louder. Currency analysts in London and New York noted that Iraq's monetary stability had been improving steadily since early 2023, thanks to better oil revenues, increased foreign reserves, and stricter oversight on foreign exchange transactions. The country's decision to align more closely with Basel through international banking standards was also viewed as a signal of long-term commitment to reform. However, skeptics reminded investors that Iraq has been the subject of revaluation rumors for over a decade, every apparent signal turning out to be either a misunderstanding or premature optimism. What made this particular event different was how technically precise and time-bound the data glitch had been. It was not a rumor spread on social media, but a measurable event visible through certified data feeds used by banks and traders alike. This detail gave credibility to those who believed the country might be quietly preparing for a recalibration of its exchange rate mechanism. Meanwhile, within Iraq, local financial experts began drawing attention to the recent technological upgrades being implemented by the central bank. In the last quarter of 2024, the CBI had completed a nationwide integration of its new electronic financial management system, EFMS, designed to automate cross-border payments, enhance compliance with international anti-money laundering standards, and eventually allow smoother participation in global trading systems. Such a system, if tested publicly or internally, could easily produce what appeared to be an exchange rate fluctuation if not fully synchronized. Yet, others insisted that the short-lived change aligned too perfectly with known revaluation models previously discussed by Iraqi economists, suggesting that perhaps what the world had seen was not a glitch, but a glimpse of a test run. The intrigue deepened when several private banking officials anonymously confirmed that new training sessions had been held in late September 2025, focusing on exchange rate system adjustments and real-time international transfer readiness. These workshops, though routine on the surface, were attended by technical teams from Iraq's top-tier banks and overseen by international consultants. That timing corresponded precisely with the weekend before the rate anomaly appeared online. To the trained observer, this connection was difficult to dismiss as mere coincidence. At the same time, government-backed newspapers in Iraq began publishing articles encouraging public confidence in the dinar, urging citizens to hold rather than convert their local currency to dollars. This form of subtle communication, seen in other nations before significant monetary announcements, hinted that policy preparation was well underway. Outside Iraq, financial markets reacted cautiously but noticeably. The Forex trading community, particularly those specializing in emerging markets, observed a temporary spike in speculative positions related to the Iraqi Dinar. Data from several regional exchanges showed that online searches for Iraqi Dinar Revaluation and IQD-USD live rates increased by more than 400% in just 2 days. While no mainstream financial institution officially altered its forecast, private investment forums and trading analysts began re-examining their models, trying to estimate what a hypothetical revaluation might look like if Iraq indeed decided to adjust its peg. Conservative projections suggested that the dinar could appreciate modestly to a range between 800 and 900 per US dollar, rather than the dramatic parity some investors fantasized about. Even this minor upward movement, however, could represent an extraordinary gain for those holding physical currency or related assets. Amid the frenzy, it is worth noting the calm resilience of the Central Bank of Iraq, which neither confirmed nor denied any ongoing policy tests. Instead, its spokesperson reaffirmed the nation's commitment to a stable monetary environment and readiness for future reforms when conditions permit. This cautious phrasing drew attention because it subtly acknowledged that reform was not hypothetical. It was expected. Analysts from regional think tanks interpreted the statement as a strategic deflection aimed at cooling speculation while quietly maintaining market stability. For Iraq, the stakes are high. Premature leak or public panic could disrupt trade, harm investor trust, and even invite external pressure from entities like the U.S. Treasury Department or the International Monetary Fund, both of which have historically monitored Iraq's monetary policy transitions. Beyond the immediate financial implications, the event revealed something larger: the shifting geopolitical power dynamics in the region. Iraq's growing partnership with China through the Belt and Road Initiative, coupled with increasing trade settlements in local currency rather than the US dollar, signals a broader move toward financial independence. If Iraq were indeed planning to revalue its currency, even gradually, such a move could symbolize not only economic confidence but also political autonomy. A stronger dinar would enhance Iraq's purchasing power, reduce import dependency, and strengthen its ability to negotiate energy contracts on its own terms. However, this potential empowerment also brings challenges. Higher currency value can hurt export competitiveness and complicate debt management. Thus, policymakers must balance ambition with caution, ensuring that revaluation, if it happens, supports sustainable growth rather than short-term market euphoria. By midweek, the story began to fade from international headlines, yet the aftershocks persisted across financial forums. Screenshots of the mysterious rate change continued circulating, discussed, debated, and dissected. For the ordinary Iraqi citizen, life remained unchanged, prices stayed stable, and official exchange counters operated as usual. But for the global financial community, the question lingered: was this the start of a historic currency shift or merely another mirage in a desert of speculation? Whatever the answer, one thing had become clear: the Iraqi dinar was no longer a forgotten currency on the sidelines. It was now a centerpiece in the global conversation about economic reform, digital modernization, and the unpredictable nature of financial transformation in the modern era. As October 2025 progressed, silence from Iraq's financial authorities only fueled more speculation. The Central Bank of Iraq, CBI, communications became noticeably restrained, issuing short, technical updates, but avoiding any direct mention of the so-called rate incident. That silence, to seasoned observers, spoke louder than words. Historically, when central banks across the world have prepared for major monetary actions, from Vietnam's gradual dong adjustments to Kuwait's post-war revaluation in 1991, their communication strategy followed a familiar pattern: limited statements, heightened system testing, and a visible tightening of currency flows. Iraq appeared to be following that same trajectory. The nation's financial indicators, too, were aligning with that possibility. In recent months, Baghdad had reported consistent economic growth of over 4.5%, with inflation below 3%, a strong signal of underlying monetary strength. Additionally, oil exports remained steady at over 4 million barrels per day, and foreign investment, particularly from Asia and the Gulf states, had quietly increased through 2025. For economists, these were not the numbers of a struggling economy. They were the building blocks of currency confidence. Still, beneath that surface optimism lay a sense of caution and geopolitical complexity. Iraq remains a country influenced by both Western financial systems and Eastern trade partnerships, walking a delicate line between U.S. policy guidance and Chinese investment strategy. Its economic independence, symbolized by a potential revaluation of its currency, could shift regional financial power balances. The US dollar has long dominated Iraq's trading system. New bilateral agreements with nations like Turkey, Iran, and China have encouraged the use of local currency settlements. If the dinar were to strengthen, it would reduce Iraq's dependency on foreign reserves and bolster its ability to price oil independently, a move that could ripple far beyond its borders. Some financial experts even suggest that Iraq's future may involve partial integration into a regional currency basket, similar to the model explored by the Gulf Cooperation Council. Such a system would grant the dinar greater international legitimacy, potentially paving the way for a slow, controlled appreciation rather than an overnight surge. The broader context, however, remains critical. Iraq's path toward a revaluation is not just an economic process, but also a political balancing act. Any significant adjustment to the dinar's value requires approval from multiple layers of authority, from Parliament's Finance Committee to oversight from international monetary partners. Internal factions, each with different economic priorities, have often slowed reform progress. While reformists within the CBI push for modernization and integration with global banking systems, others fear that abrupt rate shifts could invite inflationary pressure or destabilize state contracts pegged to the US dollar. Moreover, the shadow of the parallel currency market, which continues to exist despite regulatory crackdowns, poses a constant challenge. This market often trades dinars at unofficial rates, making it a barometer of both public sentiment and investor confidence. Interestingly, following the mysterious rate incident, these unofficial markets temporarily contracted, fewer transactions, lower demand for dollars, suggesting that even subconsciously, people were preparing for something bigger. What stands out most in this evolving narrative is how Iraq's revaluation story has transcended numbers to become a symbol of national renewal. For many citizens, a stronger dinar would represent more than financial gain. It would mark Iraq's return to stability and dignity after decades of economic struggle. For the global investor community, it represents the ultimate high-risk, high-reward opportunity. Yet, amid that excitement lies the quiet reminder that revaluations of this scale are rarely spontaneous. They are meticulously planned, coordinated, and executed only when every structural piece is in place. Analysts estimate that if Iraq continues on its current trajectory, the groundwork for currency adjustment could materialize within 12 to 18 months, possibly rolled out in stages to prevent market shock. That would allow banks, traders, and the general public to adapt gradually while maintaining economic equilibrium. Meanwhile, the international media's fascination with the Iraqi dinar remains unwavering. News networks continue to run segments analyzing oil-based currencies, digital transition projects, and Iraq's increasing alignment with blockchain and fintech modernization. Earlier in 2025, the CBI announced trials for a digital dinar prototype designed to increase transparency, track financial flows, and reduce corruption. Such innovations, though technological in nature, are often precursors to broader monetary shifts. If Iraq succeeds in digitizing portions of its economy, it could accelerate revaluation timelines while ensuring tighter control over liquidity. In this light, the so-called glitch might have simply been an artifact of these parallel upgrades, or it might have been, intentionally or not, the first visible signal that the infrastructure for a new valuation framework is already active. As the year edges toward its final quarter, one truth has emerged clearly. Whether or not that brief rate change was real, the psychological impact on both domestic and global markets has been profound. Iraq has reclaimed its place at the center of financial conversation. Investors who once dismissed the dinar as a speculative novelty are now revisiting its fundamentals. Economists, too, are beginning to recognize Iraq's improving fiscal discipline, its resource potential, and its expanding regional influence. And within Baghdad's corridors of power, the quiet confidence of policymakers seems to suggest that time is working in their favor. They no longer need to convince the world that Iraq is ready for a stronger currency. They simply need to decide when to reveal it. So, was it truly a technical glitch or a carefully managed glimpse into Iraq's financial future? Perhaps the answer lies somewhere between the two. In a nation preparing for its next great leap, testing the boundaries of technology and policy before unveiling what could be the most significant revaluation of the decade. For viewers and investors alike, the message is clear: stay informed. Stay rational and watch closely, because change, real change, often begins not with an announcement, but with a moment just like this one. And now, as this story continues to unfold, we invite you, our audience, to be part of the conversation. What do you believe truly happened that day? Was it a mere software anomaly or the quiet rehearsal of a long-awaited revaluation plan? Share your thoughts below. Let us know where you stand. And don't forget to subscribe to True Dinar Value for factual, data-driven insights into the Iraqi dinar, global currency reform, and financial developments shaping our world today. The truth may still be hidden in the numbers, and together we'll uncover it.